How much money do you need to retire? A question that I'm asked almost daily from clients and peers. While there is no magic number that enables one to retire, I will show you the formula that we use with our clients to begin to answer this question. My name is Carmine Coppola, and I am the co-founder of Strata Capital. I have personally helped hundreds of people retire over my career, and in this video, I'm going to show you the framework that we use with our clients to help them understand how much money they will need to retire. I'm going to share a few examples that will give you a better understanding of how you can start thinking of your retirement and finding out what your target number is. There are three main components that you need to focus on. 1. How much are you spending in retirement? 2. What are your fixed income sources in retirement? This can be pension, Social Security, etc. 3. What is your portfolio value or projected portfolio value going to be at retirement? This is the number we often are solving for. I'm going to demonstrate the relationship of these three components by showing you different retirement spending goals and the portfolio amount or the amount of money you would need to make up the shortfall. Let's get into it. Before we jump in, for the purpose of these examples, we are assuming that distributions from investments are coming only from retirement accounts. This is important because it means they are taxed as ordinary income. Taxes are often an overlooked expense in retirement that can have a huge impact on your income plan. When withdrawing from investment assets in retirement, you need to determine a withdrawal rate that will give you the income you need and also make sure you do not run out of money over the course of your entire retirement. For these examples, we are going to be using a 4% withdrawal rate. I will save our methodology on portfolio withdrawal rates for another video. Let me introduce you to Joe and Maria. They are both retiring this year and will be collecting Social Security right away as they are both at their full retirement age. They determined that $8,000 per month is what they would need for retirement spending. The first thing we need to look at is their sources of income. For Joe and Maria, like many of you, that is just their Social Security income. Their combined income from SSI will be $5,500 per month. That leaves a gap of $2,500 to reach $8,000 per month for their spending goal. So you might say, can't they just pull $2,500 from their retirement accounts to make up the difference? The answer is no, because we must consider taxes. The amount they would have to pull from retirement accounts is actually just under $2,800 per month, making their total monthly gross income just over $8,200. When we are income planning for our clients, we run a tax calculation using our software to determine the estimated taxes owed. There will be a link in the description to download the sample tax reports we are using so you can get a better understanding of how they work. In this scenario, $220 of federal taxes would be owed for each month for Joe and Maria. Keep in mind, we are only accounting for federal taxes in these examples. If you live in a state with income tax, then you will have to factor that into your calculation as well. This puts their net income slightly over the $8,000 per month they wanted in retirement. So, how much do they need in investment assets? If you recall from earlier, we were going to use a 4% as a withdrawal rate. So that means they would need to have a portfolio value just over $831,000 to generate this income comfortably throughout their retirement. We got to that number by dividing the annual distribution amount, $33,250, by our withdrawal rate of 4%. Joe and Maria changed their mind and decided they would like to spend $10,000 per month in retirement. So, how much do they need now? Logic says they want 25% more in monthly income, so that means they would need 25% more in investment assets, right? Wrong. And let me show you why. We already know that combined Social Security income is $5,500 per month. The gap we need to fill after taxes is $4,500 per month. Joe and Maria would have to make monthly withdrawals of $5,333 per month to make up the difference. The tax payment in this scenario would be just under $800 per month. You'll notice that the tax bill is more than tripled from the first scenario, even though the withdrawals from retirement accounts did not even double. There are two factors causing this. 1, you are pulling more money out of your retirement accounts, so that leads to more taxes due on the distribution, and it also increases their effective tax rate. 2, because Joe and Maria's total income hit a certain threshold, a larger portion of their Social Security becomes taxable. In our first example, only 37% of their Social Security was taxable, whereas in this scenario, because they're pulling out more money of their retirement accounts and increasing their total income, 77% of their Social Security is now taxable. Once again, the links for the tax reports will be in the description for you to download to get a better understanding of how this works. So, how much do Joe and Maria need in retirement accounts to support their $10,000 per month retirement spending lifestyle? The answer is $1.6 million, almost double of what they needed in the first example. Joe and Maria come back and ask, what would it take to spend $12,000 per month in retirement? Let's go back to the drawing board. They have $5,500 in Social Security coming in. They would need to pull out just over $7,800 from their retirement accounts. Let's net out the taxes due to get our $12,000 per month in income. In this scenario, because they are pulling out almost $100,000 per year from their investments, it pushes them into a higher tax bracket. The amount needed in retirement accounts to support this lifestyle is $2.35 million, more than triple the amount needed compared to the spending $8,000 per month. You can see from the three examples that there are multiple factors that need to be considered when planning out your retirement income strategy. Your lifestyle spending is a major factor to how much money you are going to need. That is why it is advisable to start planning this ahead of time so you can start saving earlier rather than later into your investment and savings accounts. There are other things to consider. These examples assumed all portfolio assets were in traditional 401ks or IRAs, meaning they are taxed as income upon distribution. But what if you had other investments, such as taxable brokerage accounts or Roth IRAs? That would impact the taxes paid in retirement and the portfolio value required. Here's what those same three examples would look like if distributions came from Roth IRAs instead of traditional IRAs. A quick refresher on Roth IRAs, distributions from these accounts come out tax-free. You will notice right from the start that taxes are significantly less. Because there is no added tax from the Roth distributions, the amount of investments needed is lower in all scenarios. In fact, Joe and Maria's Social Security remains mostly untaxed because the Roth distributions do not add to their taxable income. Decreasing your tax expense in retirement lowers the amount of portfolio assets needed to create your desired income. Our clients usually have a combination of all asset types, and you will most likely too. Because of this, we need to carefully plan which accounts distributions come from for our clients to manage the tax liability. Another factor to consider is, what if you have other fixed income sources, such as a pension? A pension would reduce the amount needed to take from your portfolio. While there's not any difference in taxes since the pension in this scenario is taxed similar to the IRAs, the income gap is much lower. This leads to needing less investment assets to support Joe and Maria's lifestyle. Looking at the $8,000 per month scenario, the $2,000 per month pension lowers the distribution from the IRA to $771 per month. The assets needed to support this income is just over $230,000, around 27% of the balance in the original scenario. As much as we would like expenses to remain constant in retirement, they most likely won't. If you have children, you may want to pay for their wedding or help them with a down payment. You may plan some big vacations, and you should, which fall outside of your regular monthly expenses. And let's not forget about the unexpected expenses that can pop up out of nowhere. The way we approach this with our clients is to model an in-depth forecast that takes into account all factors, investment returns, withdrawals, taxes, expenses, inflation, etc., and revisit it every year. I forecasted Joe and Maria's $10,000 per month example over the entirety of their retirement, but I added in some other factors. This is their cash flow over their retirement. Year 2025 represents pretty much exactly what we went through before. Total income is from Social Security, which comes out to $66,000 per year. They're spending $10,000 per month, so you see $120,000 here. Tax payment just over $9,300. The value in the net flows column is the amount they need to pull from their investment accounts. Now, if we go to year 2026, you will see some slight changes. Their income increased slightly because Social Security has a cost of living adjustment each year. You will notice expenses have also gone up. That is because we index expenses by inflation in our forecast. Taxes also increase. The amount needed from assets jumps to just over $70,000, which means they will need to pull more from their portfolio. In year 2027, we have Social Security expenses increasing again due to cost of living adjustments and inflation. However, we also plugged in a vacation goal of $30,000. Joe and Maria stated they would like to take the entire family on a vacation every 3 years. Because of these factors, they will have to withdraw a higher amount from their investments, which leads to also paying more taxes. But by knowing when this distribution will happen years in advance, we can start planning for it today. Now, let's look at their investment account balance over time. They currently have $1.8 million in IRA assets. For the purposes of this example, we are estimating a 6.5% rate of return based on their asset allocation. That is reflective in the portfolio return column. The net flows column is the amount Joe and Maria need to withdraw from their accounts. You can see year over year, their accounts slowly increase in value, even though they are withdrawing more money each year. By doing this, they are able to keep pace with inflation, maintain a portfolio balance that produces the income they need, and have the ability to pull out more from their accounts if they ever needed to, for whatever reason. The points I'm getting at here is by projecting out their retirement cash flow, we are able to start planning for what Joe and Maria will need from their portfolio in the future. Doing this allows us to construct the correct asset allocation for their investment accounts. We are also planning for risks, such as inflation, to make Joe and Maria's retirement income plan resilient. So there you have it. I gave you our mindset on how we begin to frame up the how much money do I need to retire equation with a simple back of the napkin approach. And I also demonstrated the additional analysis we do for our clients for their long-term income planning in retirement. I hope you take the strategies I guided you through today to start thinking about how much money you need to retire. Remember, the earlier you start planning, the more successful you tend to be. Thanks for watching today's video. If you want to see exactly what we do for our clients in terms of reducing their tax bill, beefing up their investments, and planning for the future, or if you want to just book a quick telewealth call, click on the link in the description. See you on the next one.